Japan's economy is all over the news right now. And let me tell you, the headlines are pretty grim. After decades of interest rates being near zero, they're finally on the rise, and a lot of people are predicting a total collapse. But what if everyone has it backwards? Today we're going to break down a fascinating analysis that argues this isn't a crisis at all. It's actually a return to normal.
I mean, you can feel the fear, right? The headlines are screaming about a Japan sell-off and some huge financial catastrophe just around the corner. But the analysis we're digging into today completely flips that narrative on its head. It suggests we might actually be watching a recovery, not a disaster.
And honestly, you can see why people are freaking out. The yield on Japan's 10-year government bonds, it was basically at zero for almost 30 years. Zero. Now look at that climb. From nothing in 2022 to a projected 2.3% by 2026. Yeah, a jump that steep is going to make anyone nervous. But what if we're just looking at this from the wrong angle? The source material we're examining makes a really bold claim. This is not a crisis, not even close. It's the Japanese economy finally waking up from this weird, decades-long economic hibernation and just getting back to normal.
Okay, so here's how we're going to tackle this. First, we'll ask if this is a crisis or just normalization. Then we'll get into something called the golden rule of debt. After that, we'll look at who wins and who loses here, savers versus borrowers. We'll also poke at the official inflation numbers a bit. And finally, we'll wrap it all up with a lesson in relativity. Let's get into it.
All right, first things first. Is this a crisis, or are things just getting back to normal? The key here is context, because you just can't look at these numbers by themselves. So check this out. The second you put Japan next to other big economies, the whole story just flips. Yeah, 2.3% feels like a huge jump from zero, but it's way, way lower than the 4.2% in the US or 4.5% in the UK. All of a sudden, Japan's high rate actually looks like the lowest and most stable one on the block.
And this gets at something even more fundamental. Think about it. The US is the biggest debtor on the planet. But Japan? Japan is the world's biggest creditor. They own tons of US debt, and they're earning about 4.5% interest on it. So let's do the math. They're making more money from their investments abroad than they're paying on their own debt at home. That's a pretty sweet spot to be in, right?
Okay, so the global picture looks pretty solid. But what about at home? You know, the headlines are all about how the government is going to go bankrupt trying to pay its massive debt. So let's talk about that. Let's look at the golden rule of debt.
Well, this analysis points out that a lot of that panic completely ignores a really key economic idea called Domer's condition. Now, I know it sounds super academic, but the concept is actually incredibly simple. It's basically a quick health check for a country's debt.
So here's all you need to know. As long as the economy is growing faster than the interest rate on its debt, the country's finances are actually getting better. So let's say Japan's economy is growing at 3%, but the interest rate on its debt is only 2.3%. Well, 3 is bigger than 2.3. Simple as that. The country's finances aren't collapsing. They're actually improving. It's just simple math.
Now, this whole thing isn't just about big government finances. It hits regular people too. And it's causing this giant hidden shift of wealth. Let's look at who wins and who loses.
Okay, so the key thing to wrap your head around is this. What happens when inflation is higher than interest rates? Well, it's simple. The cash you have in the bank, it's losing value. It's buying you less and less stuff every day. But the debt you owe, that debt is actually getting cheaper in real terms. It's shrinking.
Let's make this real. Imagine two people, okay? Both live in a place with 4% inflation. Our first person is a saver. They've got 100 million yen stashed away, earning a tiny 0.75% interest. The second person is a borrower. They have a 100 million yen loan that costs them 2.3% in interest. A year goes by, and their situations could not be more different.
So, the saver. They earn a little bit of interest, sure, but inflation just ate away 4 million yen of their money's value. So when you do the math, they're actually down 3.4 million yen in what their money can actually buy. Their wealth just shrank.
But now check out the borrower. Okay, they pay 2.3 million in interest, but remember that 4% inflation? It just wiped out 4 million yen of their debt in real terms. It just made their loan lighter. So they end up 1.7 million yen ahead. It's an amazing time to be a borrower.
So if we scale this up to the whole country, who's the biggest saver? And who's the biggest borrower? Well, the biggest saver, by far, is the Japanese public. They've been saving like crazy for decades. And the biggest borrower? No contest. It's the Japanese government itself. So what's happening is a quiet, massive transfer of wealth from the people's savings right over to the government. It's like inflation is invisibly paying down the national debt.
Okay, this whole saver versus borrower thing gets even wilder when you start to look at the inflation numbers themselves, because there's what the government says inflation is, and then there's what it actually feels like.
So officially, inflation is under 2%. But this analysis makes a great point. If you look at the cost of things you buy every day, food, gas, the real feel of inflation is probably closer to 4%. And if that's true, it means that savers are losing even more and borrowers are winning even bigger than the official stats would have you believe.
And here's a perfect real-world example of how borrowers are winning. Imagine you bought a 100 million yen apartment in Tokyo with a mortgage around 3%. Now, because of inflation and demand, the value of that apartment is going up by, say, 6% a year. Your loan cost you 3%, but your asset is growing at 6%. You're making a net gain of 3% every single year just by holding that debt. You are absolutely winning.
Okay, so we've looked at global rates, we've looked at the rules of debt, we've seen who's winning and who's losing. What does it all add up to? Well, the big idea here, the main takeaway, is all about relativity.
The core point of this whole analysis is that you just can't look at Japan's rising interest rate by itself. That's totally misleading. It's like finding one puzzle piece on the floor. It doesn't mean anything until you see how it connects to the rest of the puzzle.
Right, so it's all about context, and there are two key comparisons you have to make. First, Japan's rate compared to other countries, and as we've seen, it's actually still super low. And second, the interest rate compared to the real inflation rate. And again, as we saw, it's not even close, which is creating this huge win for anyone with debt.
It's almost like Einstein's theory of relativity, but for economics. A number by itself is kind of meaningless. It only gets its meaning when you compare it to something else. So this rise in rates, it's not a crisis signal. It's just the sign of an economy getting back in balance with the rest of the world and with its own inflation.
Which leaves us with one last pretty big question to think about. If this whole analysis is right, if inflation is making it easier for the government to handle its debt, but it's doing it by chipping away at the value of everyday people's savings, then who is really paying for the national debt?